Let's turn now to the broader markets, with all three major indices closing in the red for the third day in a row. Check out the Dow falling more than 280 points, posting its worst day since October. So is the market rally just taking a breather, or is this a sign of more pain ahead? Yesterday, you guys were all sort of cautious on where we were, and here we are now.
Well, we had I thought, a thoughtful conversation about the timing of when a deal could get done. And I think we all felt like a deal could get done, but it doesn't have to get done tomorrow. And boom, today we get some announcement on timing. Now, we don't know that that's going to be the timing, but the fact of the matter is that President Trump thought it was advantageous to sit across the pond and say, you know what, I can wait till after the elections, whether he can or whether he cannot. I think this continues to be something that hangs over the market. When you consider the movement that the market had going into this period, and the level of complacency that we talk about all the time on this desk, it's not a surprise that the market's reaction was. But again, you can see the market closed on its highs of the day and came back from a significantly lower print earlier.
It's funny. I just was in shock because it's a holiday season in that Ebenezer Scrooge. He sees all those ghosts, and I mean, I got to give it away, but Joe Lavorgna, I haven't seen him in forever. Joe, you walked over.
You just did.
I was like shocked.
So not only has he goodbyed the guest, but he brought in.
I haven't seen him in so long.
I'm in demand, guy. I'm in demand, buddy. I mean, you got to book me early.
No, I mean, look, I'll say it again. I think President Trump is playing. I think he's playing a little stock market here. I think he has he feels he has enough equity in the tank where he can take some short-term pain in December, January, maybe do something in early spring that will set him up well for the election in November 2020. I mean, if I were him and if I would use the market as the one indicator for my reelection, that's the way I would play it. Wait till the spring, step on the gas then, and then homeward bound for the election in 2020, which is why I think you could have a very painful December. I think he will absolutely go through with these tariffs on the 15th if he's forced to.
Yeah, it's house money at this point.
It's house money.
It's house money.
And he has said that, by the way.
Yeah, exactly. But we have to ask here, what is the true cost of the trade war if it drags on another year or even longer? Let's bring in Joe Lavorgna, the aforementioned Chief Economist of the Americas and Natixis, also a CNBC contributor. Joe, great to have you with us.
Thank you, Melissa.
It's fine that President Trump doesn't think he needs a trade deal to win the election, but he needs the economy. And so I guess the question is, the longer tariffs drag on the economy and to the extent that new tariffs go into place, what is the cumulative impact of that?
Yeah. I don't believe the tariffs are a big deal. And also, I hate the trade war. This is a negotiation. It might be a tough negotiation. I don't like war. I think it's sort of like belittling to what war actually is, of course. But the reason I think it's not a big deal is twofold. Number one, if you look at the total size of the tariffs, it's about $600 billion. And people compare that to nominal GDP, but actually you should compare it to total output, because you got to include business to business. Because some of these tariffs aren't final goods and services. They're business costs, effectively. And that's about a $40 trillion economy. So you're looking only at about 1.5% of the total economy, assuming everything was implemented. It's not a lot. It's really all been about the Fed. And the reason the equity market's where it is because the Fed prudently pivoted and cut rates, and housing and construction are turning up. That's why even if phase one gets done, and I can't read the president's mind, I'm not going to be a mind reader in general, even if the phase one is done, it'll still be a higher level of tariffs than where we were in the summer when everybody was worried about the equity market and the economy. And for 2020, I'm actually quite bullish on growth. I mean, you've got 1.5% job growth, and productivity's running at 1.5%. I don't know why we can't do 3% growth next year, and the unemployment rate's going to move down to 3%.
Joe, to your credit, you've actually been very bullish during periods in the last 6 months when I'm hearing a lot of people talk about recession. So let me give you the pushback, though, that when you paint that rosy picture, don't people talk about CapEx and talk about business spending and talk about business confidence and leading indicators? It's not so much about the tariffs. Every CEO is not reinvesting in their business. Every country around the world is curtailing a lot of, both trade activity, trade velocity has slowed down.
That's true. However, the sector that's arguably the most sensitive to CapEx, manufacturing, has been in recession. And that, to me, is turning. It's turning for a couple of reasons. Number one, manufacturing is extraordinarily cyclical. We see data right now that's as weak as it's been since the coming out of the recession. But you've had the Boeing 737 MAX, which is our aircraft. You've had the GM strike. You've had an inventory correction you need to work through. As we move into 2020, cyclically, manufacturing, in my opinion, is poised to have a nice recovery, and CapEx is going to go up with it. And by the way, people talk about uncertainty as if this is like a new concept. Companies may actually do more if they have to possibly plan for a couple of different outcomes. So CapEx, to me, will do okay. It may not be great, but it's going to do okay.
How about the consumer? I mean, the argument has always been that the December 15th tariffs would hit the consumer the hardest. And the consumer has been sort of the the powerhouse
well,
of
you
this
just
U.S.
proved my
economy.
point, Melissa, why the tariffs aren't such a big deal. To me, it's prudent policy. It's the only negotiating tool we effectively have. We're not going to go to WTO and adjudicate that debate for years on years. I mean, it's the only approach we have is this approach, and I think it's working quite well.
So no impact.
No, no impact is too strong. Very little impact. To me, this has always been about the Fed. The Fed has been way too aggressive in tightening monetary policy. The Fed has reversed. I'd actually see them like to cut again. Because to me, if you look at the 2-year note and the Fed funds rate, there's not enough of a spread. If you look at the Fed funds rate to the 10-year note, there's not enough of a spread. So to me, the Fed has to still cut rates. I don't think they'll do it. I like them if they did it. So we'll see. But I mean, look, the Fed funds rate at 1.63%. Find a 10-year sovereign yield in the world that's yielding at that level. No one, nowhere. So that's to me is the story. It's all been about the Fed.
Let me just push back on the consumer a little bit. Some of the tariffs until now have been absorbed at various places along the line, whether it's manufacturing or the retailer or a currency shift. That won't continue to be the case if we do see an implementation of higher tariffs. And it'll be so visible to the consumer in an iPhone, for example, if that were to happen.
Possibly, Karen. Companies ought to be more efficient, more productive. To me, this is a great excuse for companies who never would have been able to rejigger their supply chains outside of China without the president effectively giving them cover to do so. And this is, to me, longer term, I think is excellent in trying to diversify your distribution chains, your production channels, and we'll see what happens. But again, as I said at the outset, you're looking at a very, very small number. And to me, that just doesn't add up to a whole lot. The underlying trend in productivity is more important. You've had a lot of business deregulation. Some of that stuff takes time. I mean, we're trying to judge the tax cut in 17 in real time. Give it time. If this thing is in place for a while, the supply side effects will be quite positive, in my opinion. But we'll see.
So the bottom line is if you believe that the markets are reacting to what the impact of a prolonged trade war, i.e. tariffs, could have on the economy, the markets have got it wrong.
No, I think the markets have gotten it right. I think the tariffs, that's the whole point. The tariffs have been oversold. We wouldn't have gotten to 3180 or whatever it was, 3200 on S&Ps if it was all about tariffs. It's been about the market realizing the Fed, which had overdone it, reversed, stimulating financial conditions. And the variable, to me, that's the most important that I'd watch from a trading perspective. Look at the yield curve. The yield curve, uninverted, which is good. It didn't get too negative. It didn't stay negative for a long time. But, Melissa, I want to see that curve steeper. That's where the Fed needs to remain dovish.
All right. Great to have you.
Thank you, everybody.
Good to see you.
Thank you.
So I watched
All
your show.
about the Fed.
It's all about the Fed. And I think a lot of people on this desk have said that, probably correctly. I mean, I watched your show, The Power Lunch, from 1 to 2.
2 to 3.
2 to 3. That too.
But you can watch that on the show as well.
I was in Central Time. I was in Chicago when I watched it.
Sure.
But you had on an analyst that talked about 175 for earnings for the S&P, and he thought the right multiple in this environment is 20, 3,500. S&P 500. I don't know how you get there, but I think probably Joe. I'm not bringing him back, but I think Joe's in that camp.
I'll come back.
No, you're not allowed to come back.
As long as you're not
He
here.
introduced him and brought it back.
I love that.
Anyway, I'm not nearly as bullish as Joe is, but I can understand how he can make some of those arguments. I think December could be painful, and I think December 15th is going to be painful.
Pete, December painful?
I'd say you're right, and I think we'll see a big spike in vol, but I think that might actually create another opportunity, another time to actually step in, because I agree with Joe. The only thing we might disagree with,
folks.
Well, he brought me back in because of God. But the reason that I believe in what Joe's saying is I think there will be that reaction, though, because we've almost told everybody, hey, if it doesn't happen December 15th, man, this is going to be something else. So it's going to prepare folks for that big whoosh to the downside that I think will be an opportunity to buy. Today, we never got much above 17 on the VIX. And if you think about it, yes, it's coming from 11.5, but it should have gone towards 20 today when we were down plus 400 points to the downside, and we weren't even there, and we started recovering almost immediately.